We are expecting more breadth for the market. I feel like we've all been saying that for a number of years now, but that does kind of change the dynamic. If we don't have this massive tech-led rally, the 20% number is more challenging to achieve. I think we see kind of three key themes next year. One is going to be AI productivity. So actually, companies including these AI activities into their operations, finding that operation efficiency. We do see quality improvement, and like I mentioned, we do see earnings breadth. So that's focusing more on kind of the industrial rather than the consumer cyclicals specifically, and that would be kind of our third major theme for next year.
How about if this AI thing isn't a thing? I'm of the camp saying, I think the biggest risk out there is just we realize that AI isn't all we thought it was going to be, and it's been the driver of returns for the past 3 years, and we got to reverse it a little bit.
Yeah, I don't know. I think the probability of that being the outcome was far higher in 2023. I mean, I think there was a point in 2023 when we were all looking at this saying, is this the second coming of the internet, or is this self-checkout at the grocery store? I think we're definitely closer, at least, to kind of seeing the second coming of the internet, those efficiencies kind of being captured, and watching it kind of flow through to the actual consumer, being those corporations for operational efficiency.
What do you do with commodities in 2026? Do you jump into the party? Is there a little bit of FOMO? Do you take a step back, take some money off the table?
We were high on gold miners earlier this year. We are seeing interesting stuff within kind of the equity space around materials and industrials. So as I mentioned, we're kind of more positive on those areas versus the consumer areas, and specifically if we do ex-Amazon. Both are seeing, in consensus estimates, 1.5+% increases in their EBIT margins. That to me is positive. So that earnings growth, where this year was relatively flat, next year that is 10% earnings growth expectations, slightly above for those two sectors. On the flip side, for the consumer spaces, we're seeing earnings growth expectations widen out significantly, but the actual margin expectations are for sub 60 basis points of margin increases. That to me is a sales-driven kind of expansion in earnings, which is far more difficult to achieve in this coming year. So we are still positive on the space. We do think those industrial kind of cyclicals can still maintain and perform well this year.
Sean, we've had really solid earnings here in 2025. I'm thinking about the second quarter, the third quarter. Are the earnings out there for 26 enough to support this market?
So we're pretty close to in line with consensus expectations, and that's close to a 15% growth for the S&P 500 as a whole.
Where's that coming from?
It's interesting. So earnings revisions this year have been one of the things that probably surprised me most. When we get 9.5% kind of aggregate beat in Q3, and we're not seeing earnings revisions positive, there's a gap being built there. Now, we didn't necessarily see performance that drastically different than historical. So, sell side consensus was lagging behind kind of what the actual reporting number was. That is shifting a bit right now, where we are still seeing tech plus, kind of what we categorize as tech plus, and the big six, both in line with expectations of about 20% or 21% growth. That's the closest those two have been over the past couple of years. So we are starting to see that earnings breadth within the tech space. But we're also seeing kind of more positives and really the lack of a negative when it comes to the rest of the market. So at this point in time, the next year normally would have been revised down around 3%, just looking at a historical average. Right now, they're just above flat, maybe call it 50 basis points. That lack of a negative is theoretically a positive, but we're really not seeing earning revisions on that space yet. And I feel like I've been saying yet for a few months now.
Right. How are you thinking about equities outside the U.S. and how much of that should be part of the portfolio?
Yeah, I mean, we're still positive on European equities. I know European banks specifically, European financials is kind of a key positive for us. Jerry Fowler has written a lot about that this year. And he does believe that Europe is going to kind of come back into the spotlight this year. So definitely a part.
So, what's screening well for you guys these days? Is it a sector, an industry, a factor? What's screening well for you guys?
So I feel like I keep kind of emphasizing the margins point. That is definitely something we're keeping an eye on. We want to see these efficiencies. We put together a lot of work on kind of looking at sales per employee, these kind of classical metrics for operational efficiencies, and really looking at where we're not getting margin volatility. We want to see that continue. That's part of our overall quality thesis. We think the rotation back into higher quality is coming this year. That's probably one of our most preferred factors. And then, of course, the PEG factor, which I think we talked about last time I was on here, but that kind of valuation for growth. If we look at the spectrum of valuations are at extreme, but we're delivering from a margin and an earnings growth perspective where those valuations are elevated. So those two things kind of go hand in hand, and we really want to keep an eye on, who's delivering.